Guest of the morning, Arvind Sanger of Geosphere Capital Management joins us now. Arvind, good morning, or rather good evening. Thank you very much for staying up for us. How would you rate this Chinese action? Is it all green as the markets have interpreted, or would you worry that in a bit the underlying message of slowdown will hit?
Well, I think right now we have this mixed message, right? Europe is talking about last week, Draghi and ECB talked about revisiting, either extending or increasing the size of QE when they meet in December. On Friday, we got the rate cut of China. These are all signs of slow growth. And so at the end of the day, it's one of those, bad news is good news, that if there's more bad economic news, which clearly there continues to be sluggish economic news out of both Europe and China, and China's action, therefore, to cut interest rates is to offset that. Frankly, we don't think of it as having any meaningful effect on our growth expectations out of China, but it will certainly help ease the liquidity issues that they're having because of the amount of money that they've been spending.
Arvind, my point is, after getting both these news, are you going out and buying risk assets?
No. I think we're buying what we like, and we're being patient on valuations, but we're not saying, it's after the races, time to buy the markets with both hands because there's more liquidity. I would say that at the end of the day, the good news is that liquidity is going to be plentiful. The bad news is that growth is going to be rare. So we continue to look for companies where we can feel comfortable about growth, because that's the rare missing component in global and Indian markets right now. Indian markets so far this quarter have also had somewhat sluggish, if not, absent growth as an overall market. So I think that's the key challenge in India, in emerging markets, and even in the U.S. I think the growth aspect and finding companies that can deliver growth is a real challenge.
Okay, that's very well put. Liquidity will be plentiful, but growth will be rare. Victor Schwetz of Macquarie also joins us on the phone line to analyze the data overnight. Victor, hi, good morning. Do you think the central bank-led liquidity rally could perhaps extend itself?
No, I don't think so, because I don't actually believe there will be any liquidity either. If anything, liquidity is likely to contract as we go forward. In fact, what you're seeing is that U.S. dollar-denominated global GDP is already shrinking. U.S. dollar-denominated international trade is already shrinking. And so the more BOJ, ECB, or PBOC do in terms of stimulating and in terms of generating liquidity, the less ultimately liquidity they're going to end up. So what you see right now is sort of Pavlovian reflex. Liquidity means higher financial asset prices, but that is no longer the case. That was the case 5, 6, 7 years ago, but today global velocity of money is so low and has been slumping so quickly that I do not believe it is sustainable. In fact, if anything, liquidity is likely to get less, not more.
We weren't prepared for that, Victor. But let me just come to what the Chinese policymakers have done. With the reserve requirement cut, the cash released into the system is 600 to 700 billion yuan. Yep. That's what, 93 to 100 billion dollars. Will you, on that news, buy Chinese stocks or those who trade with China?
Not on those news at all. All Chinese are doing just replacing liquidity that is leaving. In other words, they're making sure that overall there is no liquidity contraction in China. And I think they have a capability of doing that because their reserve requirement ratio are very high. Their real interest rates are very high. So you find they have a capability of doing it, but that doesn't imply necessarily that you're actually injecting a lot more liquidity. In terms of buying China, we're actually buying China for different reasons, but we are buyers of China, and primarily because we're still very much in a deflationary mode, and will stay in that mode for years to come. And so commodity consumers rather than commodity producers generally should do better, and the countries that have trapped domestic liquidity should do better than countries that completely depend on the global flows. And I think China fulfill that criteria. criteria. So we're still in China, but not because they've just injected a little bit of money in order to stabilize their liquidity.
Okay, Arvind, coming to you, you just mentioned that you continue buying markets that you like. Is India on your buy list?
Well, yes, but selectively. I mean, at the end of the day, again, we're not making broad market calls. We're looking for where can we find growth, where can we find companies that have a bottom-up story that is growth sustainable, and where obviously there are no obvious headwinds from a macro standpoint. And I think right now India has at least some companies in some sectors where growth is visible. And India doesn't have any obvious macro headwinds, as your other speaker just said. You know, in a low commodity price environment and in a global deflationary low growth environment, India is one of the beneficiaries of that backdrop. And therefore, you know, as a macro standpoint, there aren't any obvious headwinds in India. You know, on the other hand, if you look at markets like Brazil and other markets that are China commodity demand dependent, I don't think the rate cut makes any difference in terms of any expectations of any big boom or even a small boom coming from this rate cut in terms of commodity demand.
What about you, Victor? I mean, you know, the Indian markets, like many other emerging markets, are over 10% higher from their recent lows. The Nifty, for instance, was 7,500 about 4 weeks back. It's quite a rally. At this level, would you still buy? Or, I mean, is there some positivity from the fact that foreign flows have resumed and domestic flows have been robust for some time now?
I don't think it's meaningful to look at lagging indicators like a flow of money because it's not particularly useful. What we tend to look at India is far more in a context of a global call. In other words, commodity consumers versus producers, domestic liquidity, or dependent on global liquidity. We also tend to look at India in terms of political pressures and structural reform, and we tend to look at India as a PE market rather than earnings market. And whenever you are in a PE re-rating types of markets, the investors tend to be very forgiving on those markets skipping and not achieving earnings per share estimates, because there's no question that Indian earnings per share estimates for the next 12 months is outrageously high. There is no way those estimates will ever be fulfilled. So the way I look at it, so long as there is some element of structural reform, so long as there is some degree of political stability, so long as there is some degree of monetary capability, and so long as we are in a deflationary climate, I'm still predisposed more towards India than say Indonesia. So when you say your market up 10%, Indonesian market up 20% in US dollar terms, far more than what India has achieved so far. So would you rather be in Indonesia right now, or would you rather be in India? I still would prefer to stay in India.
Okay, two very quick questions to both of you. If possible, a yes or a no. Victor, do you expect this ongoing risk-on rally across the world to continue for a goodish bit?
I would say there is a tendency of markets to melt up towards the end of the year, and we're probably going to see it. If that's a period of time you're looking at, then it's possible. Beyond that, I doubt it will continue.
Arvind?
Yeah, I guess I would agree with that. I think we do have, and we're setting ourselves up for a year-end rally as long as the market is, kind of buying this feel-good phenomena right now. But the real question, I think, becomes with all of this injection of, QE or similar, liquidity-supportive measures, is there any growth? And I think that is one of the challenges that we're going to face in the coming months. But we may have some room here for a rally continuing.
All right. Arvind, Victor, thank you very much for joining us with your thoughts today.